Welcome students who are taking financial accounting to the next video for the theory in chapter 1 on business accounting and you, and we're on video number 13 in the series. So let me pick up where we left off. Okay, now, all right, get my pen here. Okay, so in the last video we talked about this particular transaction. Okay, now I started to go into a little bit more detail, and we're going to see more. I realize that I'm giving a lot of information that you're going to see in the next few chapters, but I found it important to kind of give you a basis here, because if you just start mimicking this stuff without an understanding of it, you end up always mimicking. And when you come across something you haven't seen before, you don't know what to do, you become lost because you can't find it in the book. Right? It's better to have an understanding, okay, and then be able to apply it. But what we did, for this one transaction here, for the $10,000 in cash purchasing common stock, the underlying concept is everything is there, and it's just repetitive. It all depends upon the particular transaction as to which general ledger accounts you're using under whichever category of accounts. Okay, whether it's assets, liabilities, equity, revenue, or expenses. The same underlying concepts apply whether you're, for any transaction, not just an investment in the business, but if you're paying rent, paying utilities, making a sale, taking out a loan, paying off an accounts payable, it's all exactly the same, the underlying concepts. And the presentation on the paper, if you understand the concepts, you can, have quote unquote that X-ray vision to know what's going on. All right. So as we move on, all right, now what has happened is the company decided to buy $350 in supplies, and they decided to buy it on account. Okay. Whenever you hear the words on account, that means either it's an accounts receivable or it's an accounts payable. Okay. On account means your credit is being extended. Okay, for example, and we'll use the supplies here as the example. I go to Home Depot and I buy $350 in supplies. Well, if I have to pay cash for them, right? If that's the case, then instead of having this $350 for the accounts payable, I would have $350 underneath the cash account. My balance would be like $9,650. Okay, that's if I paid cash for it. But I can go into Home Depot and get a line of credit. And so I could go in and say, okay, bill me. And when, put it on my account, that's what on account means. And that means, I owe them money. Well, if I owe them money, okay, what category of account is that? Is that an asset? Or is that a liability? Or is that an equity account? It's certainly not a revenue account because it's not a sale, and it's not an expense account because I owe it. So it's an accounts payable, and it ends up under the liability. Right? So when I buy supplies on account, right, my journal entry, if I'm actually writing it in a journal, would look like this. I'm going to debit supplies for $350. Okay. Now, why supplies? Well, when I buy the supplies, it's something I own. Okay. And what's the definition of an asset? It's what you own. So when I'm buying the supplies, I think, okay, it's something I own. I'm going to look underneath my asset accounts, and I'm going to look for the general ledger account that best fits the situation. In this case here, it ends up being supplies. Now, if you didn't have a supplies account as an accountant, you would actually end up creating one. All right, but that's a whole nother story. don't go creating accounts willy-nilly, okay? And we'll touch upon that a little bit later. But for right now, I would look underneath assets and I would choose my supplies account. Now, why is it a debit? Well, because it's an asset, all right? If my balance was 0 and it increased to $350, what's the normal balance of an asset? Well, the normal balance of an asset is a debit, okay? So if supplies is an asset and I increase an asset on the debit side, that means I'm increasing the supplies as a debit for 350, and that's why I have a debit for 300 to supplies for 350. Now, because I have a debit of 350, remember, debits must equal credits. So that means I have to credit something else. Okay, well, what am I going to credit? Well, the other side, is that is that something I own? Obviously not. Is it a liability, something I owe? Yes, it is. I owe the 350. Okay. Is it equity? No, it's not equity because it wasn't an investment in the business. Is it a sale? No. And is it an expense? Well, you could say the supplies could be an expense, but in this case here, we already determined that the supplies was going to be an asset, okay? Because it's something we own. It's not something we're using immediately in the operation of the business, and that would be the difference between a supply asset and a supply expense. If we buy the supplies and we're going to inventory it, okay, we own the inventory. But if we buy a supply and we immediately put it to use in the business, it would be an expense, right? So we're buying the supplies as an asset and we still owe the money. So that means we have to look at a liability account. And when we look at all of the accounts that are listed on our chart of accounts, remember the chart of accounts is a listing of all of our general ledger accounts. When I look under the liabilities on the chart of accounts, I'll see an accounts payable account. Well, that accounts payable account had a 0 balance before, and it increased to $350. All right. Now, remember, the normal balance of a liability account, then the normal balance is what increases the liability account, is a credit. Okay. Why? Because it's what's on the right. Remember, here's the equal sign. It's on the right. So we credit it. Well, I'm going to credit my accounts payable, right, for the $350. And notice that my debits equal my credits, okay, because they increased. Both accounts increased. The supplies account increased to 350, and my accounts payable increased to 350. So that's my journal entry. And of course, I would have a date here for it, okay? But the underlying structure and the formatting of the journal entry is I put the debits first and then I list the credits second. I have columns. The column on the left, debit. The column on the right is a credit, okay? And I indent the credit as far as the description is concerned, because why? Look at the indentation for the credit, right? It's in the second column, not this first column, right? So I'll put my, from proper formatting, I have my supplies as a debit, then I indent my accounts payable. The debit is what's on the left, the credit is what's on the right, okay? So that's how I would make and format my journal entry. Right? Now, notice that what I did here, right? What I did here doesn't look anything like this over here, okay? But still, the underlying principles are there. The same exact concepts are there, okay? All right, so now, also notice that here it's showing the balances in the account, meaning it's giving a running balance. Okay, so when I look at my assets, my total assets at this point in time is the 10,000 plus the 350, or $10,350. then that's equal to my liabilities of 350 plus my equity of 10,000. So my accounting equation stays in balance. Okay. All right. So that's it. For right now, let me take a look here. What I want to see next. Okay, they're still dealing with only the assets liabilities. Okay, good. All right, so I'm going to stop the video here. And again, if you don't understand this, okay, watch it again. And if you still don't understand, feel free to give a call, and I'll pick up in the next video.